Every major economy around the world has its own central bank, and their main responsibility can be summed up in one key task: deciding how costly it is to borrow money. That single choice influences nearly every part of your daily routine: your rent, your mortgage, your credit card bills, and even whether your boss keeps hiring or starts cutting jobs. We're talking about interest rates, how they function, why they're crucial, and more importantly, what you need to understand to avoid losing out. Welcome to Gorilla Mascot. Today, we're breaking down the real price of money. Let's imagine you're buying a house, and like most people, you need to borrow the money to make it happen. To keep things straightforward, say you take a 10-year loan. The house costs $300,000, and after 10 years, assuming it appreciates steadily, it's now worth $400,000. With a low interest rate, say 3%, that $300,000 loan ends up costing you about $350,000 after a decade of monthly payments. That's still less than the home's value, so you're ahead, building equity and wealth. But when interest rates rise to 6%, things start to shift. The cost of borrowing increases so much that after 10 years, you're just about breaking even. The home's value and the total you've paid are nearly identical. If rates go even higher, you cross a tipping point. You're now paying more for that house than it's actually worth. And since that's a bad deal, fewer people want to buy, which means housing prices fall. At that point, the numbers are working against you. You're losing money simply because borrowing costs are too high. Now swap that house for a car, a credit card, a business loan, a medical bill, or even a nation's debt. The exact same rule applies. The higher the interest rate, the more your wealth drains away. And naturally, that raises an important question. If low interest rates make things more affordable, why not just keep them close to zero forever? Wouldn't that make everyone richer? Here's the catch. When rates stay low, money starts to feel cheap. Loans are easy to get, mortgages are manageable, and companies can expand almost effortlessly. At first glance, everything seems like a great deal, but that cheap money triggers rising demand, and soon enough, prices start climbing. They go up faster and faster until you're not buying value anymore. You're buying a bubble. Then comes the reversal. Central banks step in, hike up interest rates, and suddenly borrowing becomes expensive again. That crushes demand and prices begin to fall. But here's the thing. It usually takes around 5 to 10 years for prices to climb steadily, while the bubble can burst in just 1 or 2 years, and the recovery can drag on for much longer. It might take another 5 or 10 years before the market fully bounces back. Now take a look at this graph. You'll notice something clear. The ideal time to buy during this cycle is actually very short. The early phase of the rise is where billions are made, and we'll break down how that works in a moment. But if you miss that window, you're stuck with the worst scenario: overpriced assets at the market's peak, or crashing prices you can't afford to finance, because borrowing has become too expensive. So when we talk about interest rates, who's really the one calling the shots? We've already mentioned it. Every major economy on the planet operates with a central bank. The Federal Reserve runs things in the US. The European Central Bank oversees Europe. Then there's the Bank of Japan, the Bank of England, and many more. Their role sounds simple on paper, but the impact they have is enormous. They're the ones who set the base interest rate, the benchmark that determines the cost of borrowing money, whether it's for mortgages, credit cards, car loans, business financing, or even government bonds. And since the US dollar serves as the world's reserve currency, every decision the Federal Reserve makes doesn't just influence America, it shakes the globe. When rates go up, money floods into the US, and when rates drop, it flows outward, chasing higher returns elsewhere. That's why even a small 0.25% adjustment in Washington can rattle stock markets in Tokyo or send currencies crashing in places like Argentina. And we've all seen this happen recently, in real time. Back in 2020, when the pandemic froze the world, the Federal Reserve cut interest rates nearly to zero. US mortgage rates fell to about 3%, the lowest level ever recorded. Suddenly, people could afford bigger homes. Buyers flooded the market, investors poured money into real estate, and property prices shot through the roof. But by 2022, inflation had spiraled out of control. Gas, groceries, rent, everything was soaring. So, the Federal Reserve hit the brakes. Interest rates climbed sharply. By 2023, mortgage rates had surged past 7%, more than twice what they were just 2 years earlier. Practically overnight, housing affordability collapsed. Buyers couldn't qualify, sellers pulled their listings, and the entire market came to a standstill. The homes themselves hadn't changed. What changed was the cost of money. We hope you took away something valuable from this video. Thanks for spending your time with us today. We'll catch you again soon. Until then, take care.